All right, welcome back. Invest Info episode 32. And this one, I'm going to teach you guys today how to go long, short a position using Robinhood, right? And what does it mean to go long, short? Well, if you're long a position, you will need the stock to go up to profit. And if you short a position, you need the stock to go down to make a profit. Now, what I want to teach you guys today is how to make money regardless of if the stock goes up, down, or sideways. And the way we're going to do this is something called selling covered calls, right? And the way it works is when you buy an option, right? Or when you get in a position of options trading, there's a seller and a buyer. And we want to be the role of the seller. And the premium is often affected by the volatility of the price and the time of the option, right? So if a stock is highly bullish, overly bullish, it will be a great time to short it, meaning betting that it's going to go down. But we have to short it at a price that is well above our average, right? So let's use AMC for example. I have 800 shares of AMC. 100 shares, you're able to sell one option. I have 800, so I'm able to sell 8 options, right? And my average is 13.55 in AMC. As you can see, the stock fell quite a bit. However, I did sell covered calls when my average was a bit higher, and the premium for that was about $2,000, and I used it to average back down my position, so I could constantly keep selling covered calls, collecting these premiums to average down with money that's not my own. Let me show you how to do that right now. So today on open, when AMC was optimistic, I did trade options, and you could either buy or sell a call. So buying a call, meaning I have the rights to your shares at a certain price at a certain date. And selling the call, meaning I'm selling the rights to my shares at a certain price and a certain date, right? Now, let's take a look at AMC. My average is 13.55. Anything above 13.55, if I sell it, anything above 13.55 is a profit, right? So I could sell anything from $14 calls and up, and I'll make a profit. I can get infinite profits because when you short the position, you could only get as much as you sell at the current strike. So what I did was I sold out of the money call options for Friday, and that's 2 days from now. I sold 8 of these. The premium for that was it already went down. The premium to do that, meaning the person that bought my contracts paid $176. So far, that contract has fallen in value to $136, and the more this contract falls in value, I get that money. Apparently, by Friday, February 5th, this option will expire worthless. 80% of options expire worthless. So it benefits the seller of the option. So I'm in at 13.55. I sold $15 calls. AMC is currently at 8.52. So this is saying if AMC is $15 or more by Friday, I will sell 800 shares of AMC to the buyer. If it is not, then I collect the premium and I still keep my position. And the premium is available on margin for you. So I already took that premium and invested it elsewhere. All right, now let's go about it. So we're going to hit trade options. And we want to, when we get in these positions, we want to make sure we could at least have a couple hundred shares or at least 100 shares. That way we could go long short, because if we don't, we only need the stock to go up to profit. When we're long short, we can make profits if it goes up or it goes down. Right, so what I did was I scrolled up here, and I like to exit AMC at $15. I could live with that, right? Because I'm in at 13.55. Now, if I was in at, let's say if I was in at AMC at $20, that would kind of be worse, because I'll need to sell $21 calls, and you can see those are not expensive. But thankfully I did. When it was 15, I sold actually $40 calls, I sold $40 calls for about 2,000. Those calls today are worth, let's see, I sold 5, $30. So as you can see, whoever bought those options, it didn't benefit them. You know, I was in at 15. I sold $40 calls for 2,000. I want to say $2,250, and those options today are now worth 30. So you could buy it back. You know, so it's called selling high and buying low. And worst come to worst, if I'm in AMC at $50, and let's say it rockets up to 30, even $40. Well, you sell 5 at $40, $20,000 you make anyways. So boom, I'm in at my current price that I'm in is at 13.57, so anything above that is fine with me. So I did $15 calls. I sold 8 of those. And as you can see, if the stock falls or goes sideways, I'm going to collect this premium. And the premium I sold it for was 0.20 or 0.23, I believe. Was it 0.20? Let me see. I think it was 2.21. Yeah, something like this. 21 cents. Now that premium is falling, and it's going to fall. Eventually, it's going to go to zero by expiration, unless AMC is above $15 or in the money. So that's how you do it. You have 100 shares of a particular stock, and this really works well when the options trades weekly options, because you want to really close out the position within a week. You know, if you go a year out, 2 years out, and you're selling these positions, you know, the stock could do anything in a year. There's a lot of rooms of speculation, so that premium can't fall as quickly as it can when you do a weekly. So again, I'm in at 13. I'm selling a call above the price that I'm in, which is $15. I sold 8 of them because I have 800 shares, and now if AMC rockets up to $10, $12 tomorrow, I'm happy because my long position is growing. My short position will decrease. However, when your short position is decreasing or the value of the stock is going up, you don't have to cover. You could wait till expiration when the contract is over. So right now, if AMC goes up, my long position is going to profit. If AMC goes down, my sell call position is going to profit. And if AMC does nothing, my sell call position is also going to profit. This is what we call going long short. And this is pretty much how institutions make their money. Institutions, like if you can see, you have a bid and an ask here, right? You see the bid price and the ask price. Institutions will buy bid and ask at the same time. Like big banks, they buy bids and asks at the same time. And what they do is they profit from the spread of the fluctuating bid and the ask price, because they're doing this at record high speeds with algorithms and high frequency trades. So they're buying both. So we want to trade like a hedge fund. We want to trade like the banks. We want to have a long and a short position. The only thing I'll say about going long short is your net profit can be capped. But we cap it at a percentage that will give us even more than 100% gain or some sort of gain. So that's how you go long short. Doesn't matter if the stock goes up, down, or sideways, you could profit. All right, I'll see you guys in the next one.